Hey everyone, John Henry here, Slingshot Futures Trading Group, SSFTG. Welcome to the video. In this one, we're going to be doing a candle-by-candle analysis, but we're going to be going over it a little bit differently. On one of my recent candle-by-candle videos, I had a comment, and the comment was, what's the point of this? And, you know, like, why go through the candle-by-candle analysis if you could just take a screenshot and see what it is and then record a video and then you look like a genius, right? So I totally understand where the comment's coming from. I get it. And the response that I provided, I think, was relatively straightforward. Essentially, the idea is that we're looking to practice, right? Just like a basketball player stands on the free throw line and shoots the ball, he knows the outcome, she knows the outcome 900 times out of 1,000. They're probably going to hit the free throw if they're good at it. But at the same time, you know, there's an understanding that there's going to be some misses along the way, and that's just part of the probabilities. And this goes along with that mentality where it's a way that we can figure out or derive an understanding of what's going on behind the scenes so that we can create an action plan to go forward on. If we have an understanding or a contextual understanding of what is likely happening in the underlying, whether it's a psychological trap, whether it's longs getting stuck in at the top, whether it's a stop run, whatever it happens to be, when we understand the general context and the market is proving that we are understanding the context, and I'll talk about that in a second, but we can then strike and we can move forward from that. But I wanted to use this as a growing opportunity as well, because I thought this was a very interesting concept that we could take further. So instead of just recording the morning part and then calling it good and saying, all right, well, this is how it all ended out, I'm going to try to record these videos a little bit earlier in the day so that it gives us some time to build the story up to that point and then launch the video a couple days later. So we can, you know, watch it back and you can review it and see, how did the market actually respond? Was the context that we were deriving right? Was it wrong? What could we have learned from that information? And this first video obviously isn't going to have it, but if this continues, which I think it's a really cool idea, I like the concept of it, in the next video we can do a brief review of the last one, and then go forward from there and do it again, right? And then kind of keep that as a rolling thing, like every Tuesday or every Monday or something like that, so it's ready to rock and roll. So with all of that in mind, let's build some context, right? Let's go candle by candle here and kind of figure out what's going on. Because really, when we look at this overall move, what do we have? We've got this kind of an island gap, although there was a nice little leg there. This is something you don't see very frequently, where the market just rallies up or gaps up, hangs out there, gaps down, and runs away. This looks not so good. As far as the overall cyclical movement from the zoomed out perspective, we can go from the top to the bottom with a wave 1, wave 2, and then a drive all the way down to wave 3. And we can see that wave 2 was an absolute train wreck. So, if that's the case, then wave 4 is usually going to be a bit shallower and a bit more aggressive. And so far, it's only pulled back a 0.35. Comparative to wave 2, which was a 0.94, I think that's pretty aggressive. The downside objective then would be back down towards the lows. And if we're sticking with the good old fib numbers, we'll just say a 0.38 as a downside objective would be around 43.32. So the overall context here is relatively bearish. But if we look left a bit, they left behind this gap. And when that gap filled in, there was a pretty big bounce. So with that bounce coming off of that gap fill, my concern is that if the market can't make it through there this next time around and we start breaking higher, there's a chance that this ends up being this measured move in a much grander scale. A to B equals C to D, something like this. So keeping that in mind while we're going into the context of right now, we start off today, after yesterday's really heavy bear drive to the downside, with a small inside gap. Like, nothing happened, right? Just totally fine, no big deal. Don't worry about the 2% drop over here. This is just a small little inside gap up, right? No big deal. So when we have this small inside gap up with such a strong bearish trend day, yes, there was a major floor down here, but the likely context of the sellers is going to be thinking, this should keep going, right? So my first thought process is, how did these sellers respond? How did they react? So if they were looking for a short underneath 43.52, their stops would have been above the highs. A scalper's objective then would have been a 0.5, and we can see that that is exactly what came into play, along with the fact that that was a gap fill. both on the exact same price point. Talk about creating a launching pad, and launching pad it did. We have a major bounce off of that level. Now, as far as a scalper's perspective goes, you know, if we're looking at this, does this look like something that only a scalper would go for? If they were shorting below bar 1, could they go for more? Does it fit for more? Let's look at a 2-to-1. Does that fit? And we can see an immediate problem. A 2-to-1 is already below the low, so it doesn't fit. So it realistically kind of makes sense as to why the market had to search for higher ground, because it just didn't fit as far as the risk-reward perspective is concerned. Now, scalpers did get their objective on the morning drive down, but when that morning drive failed to really create any momentum, especially with a complete lack of candle gaps and bar 4 going full-out bull engulfing, it's very obvious that the market's trying to reverse trend a little bit and get things going towards the upside. Now, if they're trying to get going to the upside, what might they be looking for? If we look backward to the previous day, we had that beautiful little double top up here. So realistically, if we are going to rotate to the upside, a lot of traders are going to be looking for that as their target. Now, depending on where they got in, we can categorize what type of trader they were. If they were buying immediately as soon as the candle went engulfing, meaning that price went underneath the bear bar's low, and they put a buy order, a buy stop at 54.75 as soon as it triggered, right? Immediately as soon as it triggered. That would be one type of entry point. And those types of traders can't secure a 3-to-1. That doesn't fit. How about a 2-to-1? A 2-to-1 fits. So a 2-to-1 is basically just inside of or right on top of the previous swing high. I wish it was a little bit better, but we can see what they were trying to do. They're trying to get a 2-to-1 move to the upside, and, well, they were able to complete it. Now, if we look at this, why would they be looking for a 2-to-1? Well, realistically, at this point in time, the trend is so aggressively down that the only reason a long would go in is if they're willing to make more than they're going to lose, right? Effectively, they know the probability sucks of going long because the overall downtrend is still very prevalent. But if they can get a bounce here, it's going to be worth potentially twice as much as they're willing to risk to get that job done. So it's worth it so long as it's around 37% or more accurate. And I think realistically, given the rejection there, 37% I think is reasonable to say that that's likely going to happen. Now, it did roll back to the upside and they got a lot of those targets taken out. But interestingly, once we hit those highs, it doesn't look like they were the only ones that were trying to push back on this. There was a major rejection off the highs, so much so that they pushed down, came back with a lower high, rejected back down again. We're starting to see a lot of wicks going on here. Notably, we've also got a little pocket of wick down here, so buyers are still picking it up. But they start closing underneath it, kind of shut that down a little bit. When the market returned back to the high, noting that they closed underneath it, that would suggest that it kind of became invalid, but it still went up to the highs. Icing on the cake. Thanks, market. I'll take my exits. And everybody jumps ship as soon as it rotates up to a new high and dive bombs down to the lows. So realistically, we're coming into this with some pretty heavy bearish context, all things considered. And where we are at the moment, we've got this nice measured move, which is potentially starting to rotate down. But in the same token, if we're looking at it from a volume perspective, we started off the day in basically the same spot where we are right now. If we look at the volume perspective, it does suggest that the market participants are predominantly bearish and they're winning the fight. The big thing that needs to happen right now is the market needs to rotate down through a new low, because right now the low closes opens are holding. That's going to cause some problems. But if we can get this to rotate back down, it's very likely that the market's going to try to get a pulse lower. So how can we play this going forward then? And this is going to be where we're going to take things in a little bit of a different direction. What would be the logical way to play this approach? Now that we know what's going on, how could we lay the field in a way that would allow us an approach of both statistical and long-term averaging that are in a profitable scenario? One of the first ways, going back up to the POC. Right, the market left behind this giant POC. If we go all the way across, it left it behind a little bit further, but as we can see, that one was already used. So as far as the overall impulse POC, meaning from the bottom to the top, at least from the RTH session, that's left behind right there as a zone of interest. So as far as traders in this location, that's going to be the striking point, right? Sellers are going to be looking for a rotation off of 43.68. with stops potentially above the highs, or at least that would be the most likely objective. But what do we have? We have a problem again, right? The 3-to-1 objective is below the lows. That is a problem, that because now the market is going to have to surpass a new low, and that's just less wind in our sails. So in order to ramp up the wind in our sails a little bit, let's modify this to a 2-to-1 and see if that fits, and sure enough it does. So this is a multifaceted zone of interest. A 2-to-1 fits to the downside with an entry point purely strict at 43.68. That doesn't mean that we can't find better entry points, but if we were looking for a 3-to-1 that actually fits, we're going to have to modify the entry point just a bit to get it inside the same zone as the 2-to-1. Whoop, one off. Let's go there, and that should be about perfect. There we go. So as far as a 3-to-1 to the downside, which is a little bit lower probability but much higher reward, and you can see the difference in entry really isn't that far, this is going to be a much more favorable location at 43.70. That offers up the sellers a lot more room to the downside to fill in those objectives, and if they were looking to mitigate risk in a way that would allow them to maybe scale out of half at a scalper's position and then try to run the rest, then realistically that would also favor up in both of them, with the initial entry point as scalpers being down to 66.75. That'd be a rotation off to there. And then if we were widening that out a little bit further to the larger POC, obviously that's also going to fit the scalper's momentum, which would be down to around just underneath the 43.65s. Now, that would be to the downside, right? These are shorts looking for continuation lower. But what if the market doesn't roll all the way up here, right? What if the market doesn't make it all the way up to the top? How could we figure out how to get another way in? And that would be looking at the more near term. The very near term is still aggressively bearish and not really pulling back very much. And likely, if we can get back underneath the 43.52.75s, we should be able to roll the market back down again. And that may be the attempt to actually break the base. There we go. I had to redraw those back on. I got to remember to keep those on because we're going to have to review them going into next week. So there's a couple different variables that are taking place right now, but the sellers are definitively looking to try to control this move lower. From a long perspective, which I know feels really awkward, but from a long perspective, could this be a zone of interest? If we zoom way far out, obviously, like we talked about, yeah, this is a major zone of interest that bulls could be looking for a rotation up. Now, what kind of rotation could they be looking for? Well, if we go backward a little bit, the last rotation was off of an L5. If we cycle up again, it was off of another L5. The market is now climbing off of an L4, which means that this could potentially be a launching pad for a significantly larger move. Now, this is going to be a lot lower probability to the upside, but realistically, if we're looking at this as a break point, right now would be the potential trigger area. It would be a lot nicer to see it go maybe a bit further above, maybe, let's go from the top to the bottom. Now they're breaking above that too, so pretty soon here, actually, right around this 57, 58s, if they can gain just a little bit more emphasis, the longs have a low probability scenario for a move up. Now, low probability, I know doesn't necessarily sound very attractive, but low probability means high reward. And if we're looking at a 3-to-1 in a significantly larger scale, a 3-to-1 objective is just ahead of a gap fill and right nestled into the swing lows. So from a much larger perspective, we can also see a reason for the longs to try to be building up. Now, there are a few different ways that we could try to play this in the interim if we really wanted to play probabilities. If we were able to get an entry just a bit lower, then we could fit a 3-to-1 inside of the highs. So as an example, if we were to find an entry at around 43.42, that would allow traders a point to bounce off of that's structurally sound from before, but then also create a nice continuation bounce with very small risk, with potential for a lot larger reward. So those are kind of the different ways that I'm looking at this from both the short side and the long side. And I think both of the options are favorable, at least for a scalp. But for larger than that, we'll have to kind of play it by ear. The bigger picture, to me, looks more likely to be, well, in the grander scheme of things, really, if we get rid of and zoom out to something like a 15-minute chart and add a bit more time here. Let's go out to about 90 days. If we look at where we are structurally, the market attempted to break out underneath this major swing, and we're now trying to challenge it from a supportive point. So from that perspective, I do kind of like the long. I would like it a lot more if it broke above those major swings. The short side, like I said, I think both of them have favorability for a scalp, but at the very least, the long-term long looks like it's got just a bit more wind in the sails. We know that all of them are going to be low probability because they're looking for very large reward versus their risk, but there are those shorter term scalps. So I'm kind of interested to see what you guys think about this approach, dissecting it a little bit differently and kind of analyzing it to the degree where we can take it further forward and really kind of project what's going to happen next using the information that we derive from this. And obviously this is just the first take. There's a couple ideas that I've already had while recording this that we can kind of refine it a little bit more. But let me know what you guys think in the comments below, how you like this approach. That's going to do it for this one, though. Hopefully you found it interesting, entertaining, and maybe something new that we can add to our repertoire. If you guys hate it, we can just revert back to the other one. But it's a nice way that we can sort of practice implementation of using this information and moving it forward, projecting what the market's going to do next, and then reviewing how we did next week. And if we did bad, you guys can come back and laugh at me, haha, congrats. But at the same time, there's a lot of learning to be done during those times where we're wrong as well. So I'm going to try my best to make sure that these drawings do not get deleted. I'll hide it behind the scenes, and that way that we can come back to it on the next time around, and we'll see how we all did. So until the next one, let me know what you think about the concept. And if you have any questions or anything like that, feel free to drop those in the comments below. Otherwise, enjoy, rest up, and we'll see you all in the next one. Thanks.